Hi everyone. In the previous video, I took you through an example showing you how to calculate the present value of a real estate investment using the DCF procedure. DCF is based on sound economic theory and is a popular tool used by real estate practitioners to evaluate investments and to make investment decisions. What we want to do now is to apply your knowledge of DCF to make sure you understand the relationship between investment returns and the prices of the assets. Investment returns, as you recall, are how we measure the profitability of investments, the object that motivates investors. On the other hand, the prices of the assets, or the upfront costs investors have to pay, are what investors grapple with in the trenches of doing deals in real estate. In short, the relationship between these two is that the future return is inversely related to the price paid in the present. In other words, other things being equal, the higher the price you pay for an asset, the lower will be your subsequent return. Let's look at an example of how this works. Suppose an investor is considering buying a property he expects to sell again at the end of the year for $210,000. The property can be rented out for a total of $20,000 during the year. If the investor pays $200,000 for the property today, he will earn a return of 15%. This is calculated by first adding the cash flows of $210,000 and $20,000 together and calculating the difference between this amount and the investment amount of $200,000. This gives you $30,000, which is then divided by the investment amount of $200,000 to give you the 15% return on investment. Recall that this is simply the application of the formula introduced earlier for the simple holding period return. However, if the investor paid $205,000 for the property today, his return will only be 12.2%, as $25,000 will now be divided by $205,000. If he paid $195,000, his return will be 17.95%, as $35,000 will be divided by $195,000. As shown in the example, the return investors receive at the end of the investment period varies depending on how much they initially paid for the investment. The more the investors pay for the property, the lower their returns are. The lower the price they pay for a property, the higher their returns are. In this video, you saw the inverse relationship between asset price and investment returns, and you learned the fundamental reason for this: the independence of future rents and prices from the current price you pay for the asset, which will be a sunk cost. This emphasizes how important it is for a real estate investor to make good use of tools such as discounted cash flow to identify the value of a potential property investment. If investors pay too much for a property today, they will not generally be able to recover their mistake by charging higher rents or selling the property for a higher price than market demand dictates in the future. However, if investors manage to negotiate a good deal and pay less for a property, their percentage returns will be higher. Reflecting on what you've learned, why do you think commercial real estate practitioners often fall into the trap of paying too much for a property? How can this lead to the creation of a property bubble?